for joining us on this webinar with the RSK Group being co-facilitated by Edge Impact and the Metis Institute for Climate Strategy. Today, we'll be going through how to quantify your climate-related risks and opportunities. So just before we get started, a small piece of housekeeping. We've essentially got everyone on mute to begin with. There is an audience poll that will be going live at some stage in the presentation. And we'll also be setting aside some time at the end for a question and answer session that we are monitoring. So please shoot through some questions during the session as well, especially as they do come to mind. But before we get started, let's do a quick recap of what the agenda is going to be. So firstly, we're going to be touching on we're going to do some introductions just to confirm who are your facilitators. Secondly, we'll do a quick walkthrough of the ISSB S2 requirements, noticing this is an APAC time zone presentation. A lot of the people joining are based in Australia, so noting obviously this will capture some of the local differences, but given its similarity with ISSB, we'll be speaking to that standard. Then Rob will talk us through a worked example of how we have done this previously with some of our clients. And then most importantly, I think what most people want to see, they'll want to understand what does this actually look like in practice. So we'll show you through a couple of examples of what we perceive to be examples of strong practice in the market. But before we get started, we'll just do a couple of introductions to your facilitators this afternoon. So firstly, my name is Jake Atkinson. I'm a principal consultant at Edge Impact in our climate and nature practice. I have a background in accounting, so I started off working in industry and then slowly moved over to work in policy, working for the Climate Disclosure Standards Board, which is now part of the ISSB, as a European policy manager. I've been working in a consulting capacity in the mandatory climate disclosure space, coming up to 5 years now, some of that in the UK, and most recently, 3 of them in Australia. Rob, I'll pass over to you for a quick introduction.
Thanks, Jake. And yes, I'm Rob, Dr. Robert Charnock, and Jake and I share a common interest in accounting and how it intersects with climate change. My PhD is in climate finance with a very strong focus on accounting in the financial sector. But more recently, setting up the Metis Institute, the focus here is really looking at developing new methods through robust research. So when it comes to financial impact assessment, that's one area we've worked on. We're doing more work now on biodiversity scenario analysis methods as well, for example. So really where we come in is trying to do the research and the training side, and then we get to work with people like Jake who are really helping clients and seeing this day to day as well, making it much more practical. But Jake, I'll let you lead off for the first part of the webinar before I come in.
Thanks, Rob. We'll just go off camera while we can talk you through the slides so you can focus on them. But firstly, just to summarize, where are we right now? So recapturing those ISSB S2 requirements. So we had the alphabet soup, as it was affectionately known, because there were just simply too many standards out there. Report users, report preparers didn't know what to disclose, when to disclose, and who to disclose to. So at COP29 in Glasgow in 2021, we had the formulation of the ISSB. So since the release of their S1 and S2 standards, we've had 16 jurisdictions adopting the standards, with another 20 set to adopt on a voluntary and mandatory basis. As we can see from some of the countries being shaded, these really represent quite significant levels of economic activity. Noting that also some of these jurisdictions have previously been assigning the ISSB on a mandatory basis against similar requirements such as the TCFD. But ISSB has essentially taken the TCFD, which was about the qualitative considerations of those climate risks and opportunities, and bringing them into the anticipated and current financial effects. So as mentioned, the ISSB is a body of the IASB, the International Auditing and Accounting Standards Board, and is essentially an extension of financial reporting. So this is taking those material climate risks and actually thinking, what would the financial impact of them be? This webinar itself is for a few different participants. I think we've got over 100 people signed up. And having a quick look, it was report preparers, report users, advisory partners, tech partners, and some auditors joining the line. And we really want to, ideally, this would be people that have some knowledge of climate risk. Maybe they've done a climate risk assessment to date. Maybe you've identified those climate-related risks and opportunities. So hopefully tech working okay. I think we are just going to move to a quick poll. And we're essentially going to test, essentially just do a quick straw poll of the audience to see what the level of disclosure to date is. So I think we're then beginning to see some of the answers come through. I'm just unable to see them on my side, but hopefully that is coming through for the audience, and they are now able to see some of their current participation to date. So firstly, just in terms, oh, there we go. I believe the context, the sharing of the poll results is coming through now. So firstly, in terms of what this means in terms of the actual requirements of ISSB S2, I would just like to focus on them first before we go into the how. I think it's really important to actually think about the effects of, the requirements of climate risk. Oh, sorry, I'm just getting notified to reshare my screen. Apologies there. So just to quickly recap on what is required for disclosure on ISSB S2, we want to really split out those requirements into a few distinct buckets. So what we normally think of with the climate financial impacts is of anticipated. So we all are very, I guess, well versed with what is a current financial impact. So pretty much the focus tends to be on anticipated. However, the current impacts, in my opinion, especially in the short term of these relatively new standards, is equally, if not more significant. So this is actually about what's happened in the current reporting period. So these are slightly abridged versions of the requirements, but essentially we first want to actually disclose the effects of the climate-related risks and opportunities on the finances for the reporting period. So what has happened in the last financial year, as is disclosed in terms of general financial records, for what has transpired? Given there is lower uncertainty surrounding this, I genuinely think as a report user, this information is highly relevant. Going on, so 16A is essentially how those risks have actually affected the financial position, performance, and cash flow. So those risks have had a material financial impact, as shown in 15A, but then how have they actually affected financial position, performance, and cash flow? So how does that interact with the respective financial statements? And next one is current, but also actually forward-looking. Often within financial reporting, we make disclosures around where there may be a material adjustment in future reporting, and this requires the same. So what has happened in relation to a climate risk that essentially means there may need to be an adjustment? Could that be an impairment of an asset, for example? May there be a certain commitment that warrants a provision in your balance sheet as well? And then finally, a few specific metrics that I still think are connected heavily to financial reporting as well, as essentially this is about current or committed expenditure. So firstly, there is actually the effects of the investment in mitigation and adaptation activities. 29E is in relation to capital being deployed, and then 29G, not necessarily a financial impact, but still in relation to remuneration and KPIs, largely a policy-driven one, but there may still be a financial component for them. If an investor is looking at this information, there is that zero uncertainty point. And if we're thinking of how this can be used to judge the efficacy of the business model in adaptation in respect to climate change, this would be highly relevant information. Not just that, but when we actually think about the anticipated effects, it could be that the current basis provides some of that foundational data that we'll be using. So the anticipated is that more forward-looking perspective that I think many people are coming onto the line to hear about. So 15B is about the effects of those risks on the short, medium, and long term, including financial planning. I'm sure those time horizons sound familiar. You've no doubt been using them as part of your climate scenario analysis, and you're essentially then wanting to take those assessments and apply it from a financial basis. Continuing that, you may have some expectation of how your financial position may change over the short, medium, and long term, with a particular focus on two distinct parts. So firstly, any plans of investment and disposal. Lots of organizations are disclosing that we anticipate, for example, that you may have to commit a certain amount of financial assets to decarbonize across your emissions, for example. The next one is sources of funding. So a super common one is you say you're going to actually decarbonize the business, you have a commitment, you're going to do something, but where is that source of funding coming from? This is the main shift in sustainability reporting, is now we're looking at connectivity to the financial statements to show you're not just talking the talk, but you're walking the walk as well. 16D is around the expectation of the actual financial performance of the business and cash flow to change, And what is the strategy to manage climate-related risks and opportunities? So what are the resources available? And ultimately, can a business adapt climate risks and opportunities? How could the change of financial performance and its cash flow impact that strategy to manage its climate risks and opportunities? And then finally, just some general considerations that we may wish to think of when it comes to climate change. So these aren't necessarily points we have to put into the report, but still relevant to the disclosure. So 17, you may disclose a single amount or a range. A super common one we're seeing in practice here is the lower end, maybe that low emission scenario of a physical risk impact. And the top end, maybe that higher range. With the quantification, we're not expecting someone to predict we're going to experience X amount of dollars of impact on the 23rd of July, 2043. We're instead wanting us to judge the actual materiality of these risks. So may these affect the business from their strategy and financial performance. Noting the higher uncertainty as we go to especially going out into longer term, it's very understandable that a range may be preferable. But 21 is actually about the proportionality mechanisms that we'll be going into in a bit more detail on the next slide. But essentially, if you can't provide the quantitative disclosure, you need to explain why. You can then provide qualitative, or you can provide a combined quantitative disclosure. So that may be if the effects of the climate risks are not separately identifiable. So an example may be impacts of extreme weather. You can delineate between flooding, extreme winds, or extreme heat, for example. So you provide a combined quantitative impact, or this may be in the case of certain strategic risks that have a climate component, but it's not separately identifiable. And these ones aren't mentioned in the standards, but are highly relevant. So the first one is about consistency. I'd mentioned it in anticipated about investment and disposal, but we want to ensure that there is consistency across the financial statements and vice versa. So what you're saying in your climate disclosure should match up to the finances of your financial statements and your broader annual reporting suite. And secondly, this may have some interaction with financial accounting standards. In addition to ISSB 2, there is a C of financial accounting standards. And it may be that you choose to leverage those financial accounting standards to calculate some of your impairments and some of your impacts. It's very likely you may have an impairment model. You may have a means to calculate the cash generating units for your assets. So do think, how are you measuring those financial impacts to be consistent with what is happening in your financial accounting standards as well? So obviously what I had in the last slide was just a few lines from the financial position and cash flow section of the standard. It wasn't all of them. You might have seen there are actually a few distinct parts missing. And this is something we're going to go through to show you how we typically think about applying proportionality and relief amendments to determining financial quantification. It's obviously not as simple as us just doing an assessment and saying, we've got a number or a range, we're going to disclose it. What we found is this is an iterative process. You have to conduct this over several rounds to ultimately land on that investment grade decision useful information that can be disclosed. So if we first think how we identify those risks, we assess the materiality. Then your risk is either immaterial, don't disclose, or it's material. We're going to do a slide on materiality a bit later, but essentially when we do then think of materiality, the first thing we have to think is the proportionality relief amendments around, does the entity have the skills, capabilities, and resources to prepare quantitative disclosures? In Australia, there is a view that all Group 1s have these skills, capabilities, and resources as large companies, and we do anticipate this would be more applicable for smaller Group 2s and Group 3s, but will ultimately be a call that each disclosure to ISSB 2 needs to make. Assuming you do, you would then develop a method to quantify those risks. We will go through the methods a bit more in Rob's section, but essentially, once you develop that method, you'll again ask across 19A, are those anticipated effects separately identifiable? I mentioned some examples earlier. Maybe there's certain components of extreme weather that get grouped together. Maybe it's an existing strategic risk. For example, many organizations know energy cost is a highly material risk. However, most increases have actually recently taken place from non-climate components, so it's difficult to separately identify them. So once you've had that method, you may then decide we can do it or we can't do it. Where it's not been approved, you may then look to that line where we mentioned if you can't provide quantitative disclosures, you move to qualitative disclosures. And most importantly, identifying a roadmap to allow you to develop that method to improve data quality over time. Where it is approved, you then go out and collect the data. And there's two scenarios, obviously. Well, one is actually that the data itself may deem to be immaterial, in which case you would revise your materiality assessment. This is actually a super common thing that we're seeing when conducting these climate financial impact assessments. Maybe a certain risk was flagged as material using your enterprise risk framework, maybe from a business disruption perspective, for example. And however, when we get to the point of quantifying the risk, there is essentially a point where we speak to the finance team and they say, yes, it disrupts business, but actually, as far as a revenue impact goes, it's relatively immaterial. So that might result in an assessment and a reversion to the initial materiality assessment. It also may be the data request goes out and you can't provide the data. Maybe it's not available. Maybe you need to source additional data or have estimations and assumptions. If there's no data to do the quantification, you will again design that qualitative disclosure and use that to design a roadmap for data quality improvement. The most common scenario is actually the next two. So you may have a combination of data being supplied, existing impact data, scenario data that is available, and then some desktop research to assess availability of additional data. So maybe there's some research, some extrapolations, some third-party data sets. You go to your insurer for a data provider, and you have what you need to actually proceed with the quantification. There's the next check. So at that point, you would then actually need to pause and determine, do you have the information available at the reporting date without undue cost and effort? If you propose a method, for example, and you have to go to every single one of your sites to obtain all the data at reporting date, that may be deemed to actually be an undue cost and effort relative to the perceived materiality of the risk. We obviously would not recommend someone doing it on the outset. That is just an example, but it may be that the necessity to obtain some of that data may have an undue cost and effort. However, assuming you have that, we then begin to move to the final question. And this is the question most organizations are going to be pausing on and having to do an uncertainty assessment. I mentioned investment grade decision useful information. This is an extension of financial reporting. So we would really expect that the level of measurement uncertainty is similar to that of financial statements. We have a mandatory disclosure regime in Australia going up to limited and reasonable assurance. So obviously there is some expectation that reasonably assured information would have a low level of uncertainty. But if at conducting your uncertainty assessment, you actually then deem it's too uncertain to disclose, either as a range or a full amount, you provide the qualitative disclosure. If you pass that, you then get the quantitative disclosures that should be disclosed. Speaking with an experience of what we are seeing in the market currently, we're seeing clients going through this process. As I mentioned, it is highly iterative. And what we're typically finding is through a combination of those first few steps, they're landing on a qualitative disclosure. We have a 3-year legal safe harbor, and with an expectation of moving to reasonable assurance at year 4. So I do anticipate that some of the larger ASX organizations will be targeting that quantitative disclosure before the 3-year legal safe harbor ends. But I think there would be an expectation that quantitative disclosures with low uncertainty is available across the board in year 4 of disclosure in FY29. I think it's worth noting as well that what we're seeing right now is a relatively nascent era in the market. There's no prescribed way to do these risks, so what we're going to show is relatively new. But no doubt we will see, as we've seen the market kind of meet the demands of emissions platforms and reporting tools, that we may see standardized methods of assessing risks and data sources slowly emerge. But as mentioned, we encourage you to consider these proportionality amendments to ensure that you are putting out decision useful and investment grade information into the market. So with that, I'm going to pass to Rob, and he's going to talk us through the actual how do you get things done.
Thank you, Jake. And because I'm narrating a few client examples, I'm going to come on camera as well with these now we've laid those foundations. And I think Jake's absolutely right in sort of setting where we're trying to get to and therefore where my section begins. Now, what I mean by that is if we look at the polling where 50% of respondents said that you've already identified risks and are looking to quantify, that's great because that 50%, this next section is for you specifically. Those that have already done it, great. Hopefully this will give some ideas about how to mature it. For those of you who have not started or are just getting started, it could be that this quantification work, like Jake said, might be for the next iteration or even the iteration after that. So, if you really are just getting started, please don't be terrified by what comes up. So on the first slide, not on the next slide, what I'm doing is just saying what we're aiming for. So this is the end point of the financial impact assessment. So when a team comes to me to ask me to run through financial impact assessment, everything that I do and everything I talk about in this section is trying to lead to something that looks like this: a breakdown of the financial exposure to different risks according to their impact on the financial statements. So in particular, say OPEX and CAPEX as key aspects here. That needs to be broken down across short, medium, and long term, as well as a baseline understanding of the current effects as well. So this is the type of endpoint that we need to get to. And in the process of going from your identified risks and scoring those risks all the way through to this spreadsheet or this output, you need to have clear evidence and documentation for your key assumptions and judgments. So on the next slide is really the starting point that I would typically use if somebody approached me for financial impact assessment. This is a client example. This was a client from 2 years ago. We've got a range of different examples. But so 2 years ago, we were approached to conduct financial impact assessment for a chemical manufacturing group. RSK's climate risk team had already produced a risk register with scoring of a lot of those key risks. Now, this is just a snapshot of the physical risk register. The real one was more than 350 rows and quite a few more columns. So this is just a snapshot of those that scored highest. And for some of you, this will be quite familiar, I'm sure. What we're aiming to do from this point on is to really say that what the risks that are scoring lower in terms of their overall risk score, they are not necessarily irrelevant because they could change over time, but we're not going to do a deep dive this year. We're not going to ignore them forever. We're just going to say this year we need to do a deep dive on what's most material. So the risks that score the highest are where we focus our efforts. For this client, if memory serves, there are about 35 or 40 of these rows within the spreadsheet that had the highest risk scores. So that's where we started our work in terms of focusing. What I would like to just comment on here, however, is if you think about communicating 40 different risks, that's quite difficult when you need to approach a board of directors. So one thing that we'll typically do is, even though all 40 rows are relevant for our calculations, we will already start thinking about how we can cluster or group or categorize multiple pathways, multiple rows of this spreadsheet into one aggregate risk. So for example, we've got instances here around heat, temperature rise, and on the next slide, we'll also look at examples for transition risk too. Because transition risk, you won't necessarily get the hazard in the same way of physical, of course, but you'll get risk descriptions that are very rich, very detailed, and multiple risks can often be clustered together. So for this client, the European Union was a key market where they sold their products. So what we found is that many of the transition risks could be clustered together around some form of market share loss due to new laws in the European Union, just as one example of the many that we looked through. So the point being is that what you're then trying to do is not only conduct your financial impact assessment for each row so that you get a clear scoring of each risk and a clear financial impact, but that you can then aggregate it in a format that can be communicated to the board and that can factor into the normal risk management systems within the company. So if we move over to the next slide, what I then can start doing is digging into a bit more of what the method looks like. So this is what I'm going to refer to as impact pathways. So broadly speaking, on the previous 2 slides where we had that spreadsheet, I would see each row as an impact pathway. And when the risk register is handed to me, it will normally at least specify the outcome, if not the business impact as well. So typically, to do the full process, you start by looking at the risk. You then are looking at the outcome. So in the example on this slide, again, the diagram's from Edge, so thank you to Edge for letting me walk through this. The gas assets are being commissioned in this example. So that's the outcome of a risk around new policies. There are multiple different business impacts that need to be identified. And that's why in your risk spreadsheet, you'll often have multiple rows, even though you've got one outcome, but it has multiple different impacts. So here, 4 different potential business impacts, each of which can then be mapped onto corresponding financial impacts. So I tend to find that your job in the financial impact assessment is to make sure you've pinned down the business impacts. And where it's not entirely pinned down, you might need a workshop just to clarify that. But typically that's been done quite well already. What's not always been done by the time I receive a risk register is the financial impact. So what we're trying to do here is really then go from this stage of having a pretty robust risk register with some prioritization for the risks that score the highest. And then what we're then doing is we're making sure we pin down each financial impact pathway, because what we're going to need to do is create a calculation for each of those pathways. And as far as possible, we want that tied to CapEx, OpEx, assets, liabilities, capital and financing as well. So we're trying to get a full suite. One point I want to make here is that some groups will, maybe when they're getting started on this, just look at revenue loss as a very simple way of trying to get a financial impact assessment. That is not really what we're seeing in S2 requirements, because it's a much broader view of financial impacts. It's a back of an envelope overarching view of financial impact. It might, give an indicator, but when you're looking for a more mature assessment, that won't be good enough, if you like. So it might be something you do as a kind of first attempt without full quantification, just to give an indication to your board, but it wouldn't typically go external. The next slide then digs into what this looks like from a real example with a client. So this is a more recent client where we just finished up recently working with Edge Impact. So again, following the same logic of risk opportunity to outcome, well, when I received the spreadsheet, we had the client example outcome, which was that they were anticipating problems and disruptions in their supply chain of goods and services stemming from different physical hazards. So it's quite a broad category already. Underneath that category of outcome, we had multiple different pathways. In particular, well, I should say what we did is we ran a client workshop to discuss the pathways we identified. So we anticipated what those pathways could be. We ran a workshop with the relevant stakeholders internally to form consensus, because again, the people who are going to own the risk and have to manage the risk eventually are the people often with the right knowledge. So you do need their input to hone these financial impacts properly. Sometimes they'll bring up a point about legal liability not being in place, and so financial impact is less relevant, for example. Once you've got some consensus among those stakeholders, what you can do is then propose your input equations. So for each outcome, you'll see we propose multiple input equations here. So for increased costs due to expedited shipping, the calculation we propose is relatively simple. And I will admit, I've chosen a simple example for these slides simply because of the purpose of the webinar. When we conducted this with a client, there was overall 6 main categories of risk with 35 individual input equations. So the full document is a long piece of work with each step justified and each decision for the calculation justified too. But the point being, the input equations we come up with are not exactly complicated mathematics. It's just they need to be well evidenced, well documented, to show that they are as relevant as possible to the underlying risk and that the relevant stakeholders have been engaged to say that this is a key point. So again, this is not going to be the most difficult mathematics you ever do, but forming consensus on the right calculations and documenting enough evidence is a key part of the process. One of the big things on the next slide then is how do you take this and turn it into the numbers? Well, this is where obviously the data inputs are key. So getting sign off on those calculations, I wouldn't say is tricky. You will get a lot of feedback in the process, and that's very helpful for refining those input equations. The trickiest part is going to be what data can you get your hands on? And there's going to be different aspects that are within the company and those that are externally sourced. So here you'll see 7 different variables that map onto the 7 variables in the previous slide. And for each one, we've identified which data can be sourced within the company, because if they have direct evidence from contracts or from invoices, or they have experience of certain events and the financial impacts that they faced in recent history, that's a really good starting point of primary information for these calculations. So a lot of these data points would be, we're suggesting to the client, we roughly need a data point that connects to these key issues in order to produce our calculation. And the client will normally come back to say, we don't have exactly what you asked for, but we have data that's similar. Can you work with that? And of course, we do our best to work with it. And only if it really is causing us a problem where we think it undermines the accuracy or relevance of the calculation will we flag that additional data collection efforts are really required. But there are parts of these equations that can't be done by the client normally, because they'll require readouts from the climate models. So for example, one example that I've worked on is looking at how temperature increase would be linked to increase illness among serious illnesses among certain age groups. So for that, that's a piece where we need the scientific basis for what the increase in warming is expected to be in that scenario. And we need to find evidence on how warming is associated with increase of severe illnesses for that segment of age group. And for that, you have to go to peer-reviewed articles, reports that have been produced by the relevant bodies, associations, think tanks, and so on. And again, track where your evidence base is for this. So every data point that you've got, make sure you're documenting it. To Jake's point about assurance, clear documentation of this process is key. And when you're in the middle of populating the spreadsheet, you can sometimes risk trying to get through it quickly and not tracking where everything's come from. And that's a huge, huge problem later. The job then becomes massive. So every data point that you get, make sure you track where it's from so you can evidence it properly. Make sure it's well documented. So if you imagine this was one of the 6 different outcomes we were looking at for the client. So we're doing this type of data collection 6 times. And once we have the data to hand, we can tweak our calculations to make sure we're, our input equations, to make sure we're working with the client data as accurately as possible. But that's not the final piece, because Jake said we have a slide on materiality, and that's up next. Because again, the point of this isn't just to put a financial number on these pieces, but it's to assess how important each of these financial impacts is. Now we're pursuing the quantitative approach. So what we're trying to do here is assess the appropriate benchmark. That could be as simple as looking at revenues and costs or certain aspects of financial impact to the company as a whole. Or you might even decide in some instances the relevant benchmark could be carbon dioxide equivalent, or if you're looking at health and safety, it could be number of injuries, for instance. So in other words, find the appropriate benchmark for that particular issue that you're looking into. And then what you have is a standard, ISSB 5000, and this is going to guide the process, and you can refer to it whenever you're trying to justify your materiality approach. So the first part of that standard is saying determine the appropriate benchmark. Then you look at multiple different aspects of that standard. This can be anything around, say, measurement uncertainties, for instance, and how you can handle that to make sure that you've got a relatively sound basis for your assessment. At this point, you then start thinking about what counts as material. You may already have ranges established internally, and the examples that I'll use are from a client that did have their own materiality thresholds. So again, we aligned with their risk management system and said for point 3 here, the materiality threshold range is adopting the normal risk management processes of the organization. The job of the financial impact assessment is then to identify where are you within that range. What's the point that this particular risk is landing on within that materiality threshold range? And if you want to get a bit more detailed and complicated, ISSB 5000 walks you through performance materiality for how you might want to add some buffers around, say, measurement uncertainty in order to be a bit more prudent in the assessment of materiality here. But I'll leave that one within the standard because that's a little bit more tricky to convey in a shorter webinar. The point of doing all of this is that you then get to a point where you can determine the final materiality of the risk, and it's being compared to the normal risk management benchmarks within the organization. Now, of course, we're talking about quantitative here. If we looked at qualitative, it would follow a relatively similar approach, and ISSA 5000 covers that as well. So if you're on the qualitative aspect of your work, there is still going to be a lot of relevant information here about how you categorize and go through. But because we're talking about quantitative, I'll leave that and just flag that it's in the standard, and instead move to the next slide of a client example, where we go back to the chemicals manufacturing client and their physical risk materiality. So on the final column, on the third column here on the right, you can see severity level. And this is from the client's own risk management systems. So we didn't invent this. They had certain thresholds in US dollars for a severity 1 through to severity 5 risk. Now, severity 1 being the lowest here. So when we finish the physical risks, you'll see the hazard group here that's listed is, again, that categorization of multiple pathways. So under each individual one of those categories, there could be anywhere from 3 to 8 pathways where we've calculated the relevant impact. We've produced the financial impacts, categorized it according to severity level, and at this point, the normal risk management system of the organization kicks in. Okay, so at this point, I feel like the financial impact assessment has largely done its job, unless there's going to be a further request for more information. The next slide is slightly different because we look at transition risk, and this is where Jake's point they had on a previous slide about ranges becomes relevant. Sometimes you are going to struggle to state with any confidence the exact reduction. For example, on transition risk, what's the likelihood of policies that would reduce your market share? It's going to be very difficult to find a model that gives you a precise readout of what that's likely to be, or very difficult to find a published peer-reviewed paper that gives you that readout. Instead, what you're looking to do is assess what's the worst case and best case scenario if this were to materialize. So with that, again, you are looking to get as much evidence as possible, but also make sure that you're building consensus around those ranges with relevant stakeholders internally. At this point, it then becomes just more accurate and transparent to report the range. So that's what we're doing here. And you'll see because of the ranges involved, sometimes it will span multiple different materiality thresholds for the company. The other point I want to make here is that you see transition risk scoring a lot higher in their thresholds for materiality, severities 4 and 5 typically happening here. That doesn't necessarily mean these are going to be the hardest ones to tackle. It just means that the exposure they're facing, if they do nothing new, is much higher. Often what you find is that the mitigating measures are relatively straightforward to take from a strategic point of view and can often be dealt with in terms of the longer term investment plans as well, whereas physical risks might often require more shorter term interventions too. So just to flag that often you can see this imbalance between physical risk and transition risk, with transition risk ending higher in thresholds. Okay, I think that's going through most of what I wanted to cover off, except for one point around assurance and the auditability of this, because we're hearing much more of this. And one thing I'll say is also, please do keep your questions coming. I know we've gone through quite a lot in the slides, so please ask us the questions you've got. Anything specific that you're grappling with, do send them through via the questions function in the boxes there, and they'll pop up on screen. So the final point I want to make is about auditability. When we're looking at climate risk assessment, there are an array of judgments. Of course there are. There is a high degree of uncertainty because we're looking at the future as well, and the future is inherently uncertain. If we pretend it isn't, that's not going to be accurate. So what we need to make sure we're doing is that we are tracking and managing the data and managing the evidence base well as we go through. I've talked about this already on previous slides, but just to clarify, when we're talking about data, are we making sure we've got the source documents and any change logs and versioning that's important to keep in place? Estimates and models, this in particular is the documentation about the assumptions that have been made. Obviously, if you've done your risk assessment, you've already covered scenario parameters, but you might not have covered the assumptions about worst case and best case scenarios that have come in, or you might not have already covered the models you had to use for some of those readouts. Likewise, is the external data you're depending on reliable and relevant, especially if you're looking at transition risks? What's your evidence base, and does it meet the criteria required for reliability and relevance? Some people, this won't be many people on the call, I shouldn't think, but some people will be starting to automate some of this process. And if you are, just making sure that there's a good documentation about how the automation works in terms of controls and IT environment is especially important here. But again, that's for people that are very mature stage with quite significant resourcing and budgets as well. So even some companies, when they reach full maturity, might not be doing this as well, depending on what's in scope. A few final points, as always with assurance, if you've got use of experts, how are you assessing that they're competent for the work? Making sure that you're tracking the materiality, as we've talked about already. There's very clear standards that guide what needs to be disclosed and the process you go through, and also ethical considerations. Now, the ethical considerations are more for the auditors to consider, but it's useful for you to be aware of those too, so you don't get caught out and can at least be aware of it. And finally, one point on data providers is something we wanted to draw out, because there are lots of data providers that you can use in this process. And until recently, some data providers have kind of black boxed their methods a bit. Now, that hasn't been a huge issue pre-assurance requirements, but when there are assurance requirements, you're going to need to unpack that black box and make sure the data providers can provide the information necessary for the assurance process. So if you are approaching data providers with assurance on your mind, make sure you're checking that how can they make sure they are going to help you be audit ready, if you like, as well. I think at this point I should hand back to Jake, though. That's really covered most of the method from the start, and I'm happy to dig into any of it as guided by the questions.
Thanks, Rob. So we've seen what we need to disclose, how you actually get ready to disclose, but the million-dollar question is, what does it actually look like in practice? So I've mentioned before that we're in a relatively nascent state of ISSB or ISSB in Australia, but we've fortunately actually got a voluntary disclosure of ISSB in the Australian market. Brambles, one of Australia's most sustainable businesses, and I think just what I'm going to show here does constitute best practice, both in terms of its actual business model and what it's disclosing, but it's still something that we should all be looking to align to over those next 3 to 4 years. So firstly, it shares some of the current effects that I mentioned. So how have those risks impacted its financial position, performance, and cash flow in the reporting period? It's touched on the low carbon advantage and how that has made certain impacts on its position, performance, and cash flow. So investments exceeding $100 million, costs of waste solutions totaling $24.8 million. What I also like as well is it touches on some of its themes, such as the second one of network capacity, and it actually discloses qualitatively that there were 2 hurricanes of Milton and Helena in the US and flooding in Valencia, Spain. However, they did not have a material financial impact. So if we think of maybe the topic of completeness, it is showing that we've essentially had these physical risks, but they've not actually resulted in that impact. Noticing the same again for raw material supply, where it's disclosing to investors that we are doing annual investment for projects to secure future timber supply, an actual critical nature dependency for its business model. We've spoken about risks, but of course there are opportunities as well. I do think we focus on the risks, but what's really exciting actually about Brambles is they can attribute their revenue to a lower carbon economy through a circular business model. So that's $6.7 billion, 100% of its revenue. So obviously not saying every business needs to disclose 100% of revenue is sustainable, but this is the level of disclosure you could expect around current impacts on a risk and opportunity basis. They also make disclosures around capital deployments, which is incredibly useful. So not only do they provide that information on a quantitative basis, but they even provide prior year comparatives, so FY24 against FY25. And they also make some linkages to their financial reporting. So they talk about the reduction in pool and capital expenditure due to asset productivity. Please refer to their financial review. So they're walking the walk and making the connectivity against those different reporting suites as well. They've also made disclosures around significant risk of the material adjustment. No material adjustments expected. So even that there is none expected is investor relevant information. And then finally, it's disclosed those 2 themes. Essentially, the themes are their risks, and they've disclosed the anticipated expected changes to financial position, performance, and cash flow. So they've acknowledged that revenue may actually increase during major climate events, but it may also require insurance costs and investments. So think of those different pathways. It's essentially qualitatively describing the impacts of each of those pathways. And then it discloses the time horizon the financial impacts could start to occur in the short term. So you don't need to disclose short, medium, and long term if it's not passing that materiality threshold as well. You just have to highlight the relevant time horizon for which it is disclosed. Noting as well, they don't align this to a scenario. They just say it's reasonably expected to occur. The other point being, they talk about raw material supply, noting that investment they made in the current anticipated effects, but they also talk about supply constraints and how they think it's going to impact it in the long term. And they also make the connection to their assets and balance sheet. So they make the point around, in response to biome shifts, there may be a necessity for financial support to collaboration in their suppliers, impacting net assets. So from this, I'm able to observe quite a clear view of how their main input is that raw material supply, the mitigative effects they're doing, and how they're managing both the current and anticipated effects of those two highly material risks. Another one in a different market is Vale. So they are a Brazilian company that have also done a voluntary ISSB S2 aligned disclosure. And I really like the current financial effects of this one. They essentially show that carbon pricing is their key risk. And they show through the different inputs across briquettes and mega hubs, renewables, etc., the relevant impacts across balance sheet, income statement, and cash flows. So across all three of their key financial inputs, and they're able to clearly signpost where they are occurring, with also references to the notes in the financial statements. You know, to me, that is a very concise but highly communicative piece of disclosure linked to the financial statements. They also touch on the anticipated financial effects. So they, again, touch on carbon pricing and the costs that may occur from the increase in the carbon pricing mechanism. And they essentially acknowledge the uncertainty associated with this and then make a clear linkage into their financial report. Rob mentioned needing to document those uncertainties for the auditability, but also for your report users to really understand what some of those material uncertainties may be. So low uncertainty, clear disclosures in the current financial effects. Looking to the anticipated, they've made that linkage in the later stage of their report around the uncertainties of carbon pricing, actually disclosing the significant data points underpinning the climate scenarios that they've been using for the basis of this assessment. So not only are they disclosing that range of 1 billion to 3.5 billion, but they're being transparent in the methods and uncertainty that underpin it. To me, these are just two very strong examples of best practice in the financial reporting and disclosure space. We've looked at the climate disclosure statement, but I would like to touch on what it actually looks like in the financial statements as well. Again, using Australia, BHP is Australia's, I believe, second largest by market cap as of now, and if not one of, the most exposed companies to climate change. What I actually enjoy about this one with the notes to the financial statements is they actually have a specific note around climate change. So they basically provide a qualitative description of the climate change strategy, particularly some of the points around decarbonisation of operational emissions, managing climate risks and scope 3, and then noting the different points of the phases in their business model and value chain where there is potential impact of their financial statements. So not only have they done their climate disclosure statements to understand the financial impact, but they've used the climate information to aid users of the financial information. Again, it's the linkages. To me, this needs to not just be treated as individual data points. This should provide an enhanced view of overall business strategy, and it's the interconnectivity that really separates a strong disclosure from a non-strong one. They then have made some further accompanying notes in different sections of their financial reports. So they've noted the impact of transition risks on the carrying values of their assets, but noting there is not a separate adjustment in the group's WACC. The useful economic lives, property, plant, and equipment, they note that typically when we do think of decarbonisation, you may need to impair the lifespan of your assets, adjust depreciation, but they've been able to disclose that it's not had a material impact on the estimating remaining useful life of the existing fleet of assets in FY24. And I spoke about the committed expenditure and investment and disposal plans and committed expenditure. So they provided information on the expenditure of the $30 million to support collaborative partnerships consortiums, R&D and investment across their value chain decarbonisation. So really they've been able to interweave the different climate risks and impacts and the relevance across its financial statements. So we've seen the climate statements, we've seen the financial statements, and we're going to finally touch on how it may interact with an accounting standard. So IAS 36 is obviously about the impairments around assets. So an asset's value can often be derived from its ability to generate future revenue. You may hear the term CGU, a cash generating unit. So some of the ways this may be considered is across maybe a legal or regulatory change. Rob actually provided that example of the ranges of how a regulation may result in decreased costs of revenue, or maybe an organizational commitment may mean they need to step away from a certain market, a certain product line, or decommission an asset. Maybe the exposure of their operations to those extreme weather risks, again, might impair their ability to generate revenue, or also, and I think a super relevant one, is changing consumer preferences and market conditions. Intangible assets are growing as a share of listed companies' balance sheets exponentially. One of the largest ones we actually use is brand value, and that is based on the ability of a brand to generate revenue going into the future. So if you were to have a negative interaction with a brand's reputation, maybe due to client performance, that could result in a material reduction in revenue as a result, you could argue that intangible asset should be materially impaired. We've also then just highlighted one clear example of where Unilever have done this previously, where they've essentially been conducted estimations of their cash flows for a 5-year period, including some points around the growth rates, operating margins. They have then included the impacts of climate change from an operational cost perspective into the 3-year plan. So as well as calculating these risks, do consider what am I treating on my financial statements that may have an interaction with climate. There's significant other guidance in relation to the accounting standards. This may include the use of financial instruments, again, asset impairment, valuation, or maybe IFRS 15 with revenue. So thank you so much for joining us. We have run over a little bit in terms of the content, but that has left us with 7 minutes for Rob and I to field some of your questions. So Rob, I know you've been paying attention to the chat. Which questions have you picked out?
The question that came to me, one of them, it's a tricky one to start with, I'm afraid, Jake. But keep them coming, please. And if we can't get around to your question, we can send emails afterwards as well. So just because we're short on time, please ask away and we'll send an email that follows up after the webinars. The first one that came up was looking at how materiality can change year on year, but specifically how materiality might shift because a risk is no longer associated with climate, but a different driver instead. So we might look at, I would think of energy prices. You could look at energy prices from a climate lens, but political instability might be that. So Jake, if a company has been looking at materiality year on year, but the driver changes, how do you deal with that?
That is a fantastic opening question. So actually the climate risks that we are dealing with, climate disclosure came to exist because climate risks were material. For so many businesses, in Australia, they are material risks. And all this is really doing is expanding that due diligence and risk management to capture investor relevant information that didn't exist before. So there's firstly, in regards to the climate risk, it has to be separately identifiable to be in the climate disclosure statement. So all I would consider is if it's passing the materiality, it should be disclosed, irrespective whether it's climate or not. All you're really maybe looking at is if you can't identify those separate climate components, it wouldn't be featured in your climate disclosure. Interestingly, we've had a couple of risk assessments where clients have become aware of new strategic risks that they weren't considering before as well. So we have actually had climate risk influencing strategic risk as well as strategic risk interacting with climate. I think the particularly interesting thing will be to follow how this does evolve. We know in Australia it's climate first, not climate only, and we're soon going to probably have nature on the agenda. So how would you then reconcile potentially material nature impacts and dependencies with those climate-related risks as well? You can't necessarily separately identify them, but ultimately you touched on materiality. Performance is quite absolute. So if it's material, you have to disclose it, whether it's climate or not.
Thanks, Jake. It's a tricky question to answer. The other one, this other one might be a bit more straightforward. So obviously, I think one thing you and I know is that the methods that are out there in the market are, shall we say, not yet standardized, but there are some methods around. If you can't refer to a common kind of standard or approach, how can you justify that your methods and assumptions and so on are accurate? Normally, you'd want to be able to reference a key document or key standard to justify the steps that you've taken. What would you say, or what have you seen out there that people could use?
Absolutely, and I think we love to place reliance on those standards, especially as we're trying to mitigate greenwash past the auditability threshold. I think the first thing is noting this is nascent. We're all learning. You know, I've been seeing live almost learning between client, advisory partner, data provider, and auditor. I do think there will be some emergence of those standards, and the auditors will essentially be some of that sounding board on the way to go. But at the same time, I agree, because if you've got, you know, we have a big push in sector-based metrics and disclosures, and if every company in every sector is providing different ways of calculating those risks, that's not investor useful. So I would actually encourage, if there is ways for collaboration in your sectors from an industry body, maybe encourage them. You can place some reliance on what we think are quite, I guess, widely used metrics. So firstly, the standard does have those financial ones we mentioned. They have the percentage of business that is vulnerable to climate physical risks, transitional risks, and also maybe look to the ISSB S2 industry-based guidance metrics. And it's likely that between them and ISSB, they've taken very industry-led approaches. They may provide some guidance on some of those additional metrics that may give you some clarity. But at the same time, in the same way, I think, Rob, we saw the GHG protocol kind of emerge from that business demand. I fully expect that some quite standardized ways to calculate these risks will emerge once we get a few disclosures in the market.
I agree that I'd just add, so I've been talking to a couple of audit partners this week, and they've had some comments on this specific question as well. One point that they come back to is, look, when you start the audit engagement for this, part of the role of the auditors is to enable that capacity building. So if you're disclosing where you are on that capacity building journey and what your plans are and where you've got to, that kind of aligns with a proportionality disclosure, essentially. And then the auditor's role can be partly to hold your hands in making sure those methods mature in the right way. And they may have seen industry good practice, even if there's not the external standard as well that's available out there. So I think one final question that's just come in, if we've got time, maybe for a quick response, Jake. How are scenarios incorporated into the quantification process? Should impact quantification make use of available scenario data to ensure the process reflects some degree of scenario analysis, similar to what is typically done in qualitative assessments? What do you think, Jake?
In short, yes. So Rob, you touched on we need to get the climate models. So scenarios aren't just those ISSB kind of disclosure requirements. They are where the climate data sits, and you do have to choose that plausible future. So I think from a data practicality perspective, yes, you will have to do some integration to think about the longer term. I mentioned you don't have to disclose the expected impacts of the scenario, but you'll still need to use a scenario to estimate, and that might be a range. But also the standard does ask you to provide disclosures around resilience in respect to the climate scenarios. So ideally, I think directors are signing off on this. They would love to know there is quantitative assessments underpinning those scenarios to make determinations on that resilience.
I think that's absolutely spot on. So thank you, Jake, for that. At that point, I think in the interest of wrapping on time, Jake, perhaps is there a final remark you want to make about how people should get started on this?
I think the only thing I said more in this webinar than interconnectivity was it's iterative, the two I's of this. So please just get started as quickly as possible. As you know, we want this. When I say decision useful, I don't just mean for investors. This needs to be part of your own internal reporting. This needs to drive those behaviors, and getting started early is how we land on that holy grail of investment grade information.
Perfect. Thank you, Jake.
So thank you all so much for joining us. We will be uploading this to YouTube for you to share with any participants. I believe the recording will also be sent. If you do have any questions for myself and Rob that were missed, our contact details will be sent after the session. And just finally, a thank you to the RSK team for helping us organize this. Thank you all and have a great afternoon.
Thank you all. Have a great day.